This podcast is part of the Frederick Podcast Network. Learn more at listenfrederick.com.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor, Hummingbird Wealth Management, LLC, and Cambridge are not affiliated. Now sit back and relax and enjoy another episode of Be the Hummingbird. Here's your host, Laura Johnson.
Hello, and thank you for joining us for Be the Hummingbird, where we strive to inspire, motivate, and educate. So what are we inspiring you and motivating you and educating you to do? Well, it's really just to have some perspective on life and recognize where you might be able to improve, or recognize where you're doing something good already and just to keep doing it, or to stop doing something that's just not working in your life. So I am a financial planner, so a lot of my topics are going to be related around the whole financial side of things, but I do bring some of life's experiences into our conversations. So what is our topic today? What are we educating you on today? Well, we're educating you on a basic investment topic called risk tolerance. So risk tolerance is one of those things that as a financial advisor, we look at to try to determine for our clients what's the best portfolio, what's the best asset allocation, and what's the best diversification, throwing all kinds of terms at you today, that's going to work for our client. And so when you're looking at your risk tolerance, it's your ability and your willingness to take risk. And we're looking at not only your ability and your willingness to take risk, but how that aligns with what your goals are. Whether those goals be to retire, that seems to be the big thing that a lot of people are looking at today. Well, not today, any day in my 30-year career. But also, goals like, planning for a wedding. My beautiful photographer, videographer is getting married in the next year. And so, some planning for that, or buying a house, or having children, or making a large purchase of some sort. Then what comes into risk tolerance, and I'm going to be honest with you, this is the biggest piece of it all. And it's your emotional comfort. It's those things in your head and your heart that cause you to make some of the decisions that you're making. So risk tolerance, we're going to start with some of the basics here. The first thing we look at is time horizon. So you might have a pocket of money that you have a specific goal for. So there's a goal, and that goal has a time horizon for it. And let's say that time horizon is 5 years. You want to buy a house in 5 years, and you have a chunk of money that you're going to use as a down payment. And so you want that money to grow, but you only have 5 years. You would have maybe a less of a risk tolerance for that money than someone who is using the money they have for retirement and they're not retiring for 30 years. So you have that ability to be more aggressive. And aggressive, I don't really like that word, by the way, because it sounds scary. But you have the ability to take on more risk maybe for that 30-year goal of retiring rather than that 5-year goal of buying a house. Doesn't mean you can't invest the money that you want to use as a down payment on a house. It's just we might do something a little more moderate, something that has a better blend of stocks and bonds and mutual funds and cash. Whereas that aggressive, the word I don't like, but that more, long-term goal of retirement in 30 years, we might be able to do more in the area of stocks and mutual funds and less in the area of bonds and cash. Now, that's just looking at time horizon. The other thing we take a look at when we're determining risk tolerance is your overall financial situation. So I'm going to give you a perfect example. I had a client come in to me a couple of weeks ago, and my client says, hey, I need to start saving for retirement. They were in their 30s and didn't have access to a 401k plan with their employer. And they're like, I want to do an IRA. I want to do a Roth IRA, whatever the thing is that I want to do. And I said, okay, well, before we can open up this account and start investing for you, I need to take a look at your overall financial picture. And of course, I got a little pushback because sometimes that happens. But when I evaluated this particular client's overall financial picture, they had an excessive amount of credit card debt. And that credit card debt, in case none of you has looked at your credit card bills lately, I would highly recommend it. All of his credit card bills had interest rates in excess of 24%. So I don't know what investment you think that's going to outpay 24% consistently, because your credit card's charging you that consistently. So I had to have a different kind of conversation with that client. Saving for retirement is important, but making sure your financial house is in order is equally, if not more important. So when we're looking at risk tolerance, going back to the topic at hand, what we try to take a look at is you have a goal. That goal is important, but let's make sure you're financially stable enough to be focusing on that goal. Is it your priority right now, or is something else your priority? So that is definitely one of those things. Now, how else do we determine risk tolerance? Well, investment experience is a big one. I have individuals who come to me in their early 20s and they're like, gung-ho, let's buy XYZ stock because it is the latest and greatest thing. And I know it's going to be crazy volatile, but I don't care. The world is my oyster and I can do anything. But they have absolutely zero investment experience. So as a financial advisor, it's my job to educate them. Well, XYZ stock it's a small cap growth stock that has a lot of volatility inside of it. It's going to be risky. And a lot of times what I'll hear back is, that's okay. I've got time. Yeah, they got time until they see that first statement. So I'm going to use big numbers to make sure that the impact here is pretty powerful. When you have something on a scale of 1 to 10, where 1 is the most conservative and 10 is the most aggressive, and you have something a 10, like it is the most aggressive thing that you can have, it typically is going to have a volatility of plus or minus 40%. And that's just an average. So what does that mean? That means sometimes your account, that investment could go up 40%. Woohoo! My $100,000 just went to 140. You are happier than you've ever been. It's the time when you open that statement, it's gone down 40%. And so 40% just in numbers, it went from $100,000 to $60,000. That's the conversation as a financial advisor I'm having with my client. You're telling me, oh yeah, I can take that risk, give me a 10. But when you open your statement and you see it go from 100 to 60, how you feel? What are you doing? Are you showing up at my office, banging on the door, yelling and screaming? Or you're like, you know what, I'm in this for the long haul. I told her I had high risk tolerance. I have faith in this company. I have faith in my advisor, and we're going to keep going. So that's where the reality check is. When you don't have investment experience and you haven't actually seen your statement go down, you really don't know how you're going to feel till that happens. So a lot of times when we have someone with very minimal investment experience, we might start them off a little more conservative than they think they can handle, just until they've seen it and they've handled it. Now, not all advisors are the same. You know, someone might just say, okay, you said aggressive, we're going to go aggressive and good luck. That's not how I operate. So investment experience is another big piece of it. So this is the biggest piece, and I've mentioned it already, and that's your personality. It's how you handle things emotionally. It's your attachment to your money. So it's that whole behavioral science piece of money. And this is real. You know, we all have some kind of money story. We save based on our life experiences, or we spend based on our life experiences. Sometimes when money is brought up, people, you know, they tense out, they might freak out, you know, have anxiety moments over it. And some people are like, yeah, I don't care. You know, they're pretty aloof. It helps to balance out a marriage. I'm going to be totally honest with you. My husband, he's, I don't have a clue, and he's Mr. Cheapo and doesn't buy anything, where I'm the person that, okay, I save, but I spend. I save, but I spend. I have a purpose for my savings and I spend it, where my husband's like, yeah, we're not spending any money. You know, gallon of milk went up a couple dollars, and he's like, well, we can cut back on milk, right? So it's good. The two of us balance each other out. So how do emotions play in investing? And I mentioned this already, is if you opened your statement and it was $100,000 and now it's $60,000, how is that affecting you? You know, is there some kind of factor of fear that's playing into that as well? So there's your tolerance, which is the feelings kind of thing. And then there's your capacity. That's what you can really handle. And so what you can handle is determined by things like questionnaires, like what kind of time frame do you have? What are you trying to accomplish with this money? What is it? What is your experience with investing? That is your capacity. But your emotions are your tolerance. That's your feelings around losing money or gaining money and what you feel about that. So the thing about risk tolerance, it's very similar to this thing called financial planning. I have a lot of clients that come in to me to have a financial plan, and they say, okay, well, I'm 45 years old. I want to make sure I'm on target to retire at 65. So it's a 20-year time frame. We look at their taxes, we look at their investments, we look at their spending, all the things. And we sit down and say, okay, based on where you are today and what we project things to cost later on in life, that little thing called inflation, you are or you are not on target to accomplish your goal. And so along the way, you're going to have to make some adjustments in order to hit that goal. The thing about financial planning, which is the same as risk tolerance, is the minute you walk out the door with a financial plan, it could become sour, I guess you could say. Because a month later, a year later, things might change. You might lose your job, get a raise, inherit money, get sick. The economy might explode and do great. The economy might blow up and not do so great. So all of these things are affecting your financial plan. Well, at the same time those things are affecting your financial plan, they may or may not be affecting your risk tolerance. So there's some things that you want to make sure that you're doing both with your financial plan and your risk tolerance, and that's regularly evaluating them. As you get closer to whatever goal you have, whether it be retiring in 30 years or buying a house in 5, is your tolerance for that risk lessening? Are you feeling like, okay, I know I said I was a 10, let's back it down and let's make it an 8. I feel a little better about that because I'm getting closer to that goal. Is that something you want to do? Or on the flip side, have the market's done so well that you're like, what, let's gather some of this growth and let's take it down a little bit. I'm not greedy. I want to make sure I'm hitting the goals and I don't want to lose what I've already gained. So risk tolerance is definitely something that you want to make sure that you're reevaluating, just like you're reevaluating your financial plan. So what are some of the common, I guess you could call these biases or common mistakes or something along those lines? One of them is loss aversion, and that's fear. When we operate out of a mantra or a mental state of fear is always 100%, without a doubt, guaranteed, going to hold you back from whatever it is you're trying to accomplish. When we make decisions out of fear and don't take some of the risks that we need in order to accomplish our goals, we are almost guaranteed that we're not going to accomplish those goals. So I'm going to give you an example. This has nothing to do with money. So I've always been a big girl all my life, and I liked to exercise, but I always had a fear of making a fool out of myself at the gym. I'm kind of laughing at myself right now because I take videos of myself all the time now. I'll take pictures of myself all the time. I'm like, hey, everybody, look at me. But that fear of being judged at the gym held me back from going to the gym for decades. So I finally woke up one day and said, what am I so afraid of? What's the worst thing that's going to happen? Well, it's nothing worse than being fat. It's nothing worse than being weak and not being strong. And I finally stepped my foot in that gym. And today, I actually was at the gym. Didn't do as well as I'd like to have done today, but I still did. Bench pressing 120. I mean, hey, I don't know. I'm 58 years old. I'm pretty impressed by that, But for the decades that I didn't do that, I was operating out of fear. And now that fear has started to subside. And the same thing can translate over into your money. Don't be so fearful of winning that you end up losing. And that's the same thing that can happen in investing. On the opposite side, we can be a little overconfident. We can be like, yeah, I think the current administration in the White House is really going to kick it. And we're going to jump in all feet, arms, everything, my entire body, all of it into the stock market. And it's like, whoa, 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 whoa. But you got a 5-year time frame. You got a moderate risk level. The markets are a little volatile. Are you sure you want to go all the way on a 10? So being overconfident can have some negative repercussions on that as well. And there's this whole concept, our fear can drive our decisions. So, last year, let's say, the large cap growth part of the market was good. So this year you're like, hey, I'm going to chase after the large cap growth. That's not a good thing. You want to make sure that your portfolio is diversified. Okay. You want to make sure that it's doing what it needs to do. But on the flip side, your accounts go down. The knee-jerk reaction is, again, that fear to say, hey, I'm just going to pull out for a month or two and see how things going. Well, I don't know about you, but I don't have a crystal ball that tells me in that month or two when's the best time to get out and when's the best time to get in. And so again, there's a theme going on here, and that is fear. Don't operate out of fear. Operate out of knowledge. Make sure you're as educated as you can be. Make sure you're working with a professional, if that's your choice, that is listening to you, not just giving you what they think, but also taking into account what you're going through. So I hope you found this to be educational, maybe a little inspirational and motivational, and we are happy that you've joined us. This podcast has been brought to you by Listen Frederick, and as always, it's not goodbye, it's see you later.
Live radio, local podcasts, the Frederick Podcast Network at listenfrederick.com.